Let's talk to Julian Callow. He is head of international economics at Barclays Capital. Julian, thank you so much for joining us. It seems, we have it pledged, but we don't know what the details are. They talk about some kind of recapitalization plan. Merkel also saying that we need to change the treaty. Really, is this going to be a confidence vote? Are we going to get anything at all that the markets need, something substantial in the next 3 weeks?
I think we are going to see some changes here because clearly there is this strong intention to actually achieve something in time for the G20 summit in Cannes in early November. So I do believe that the summit outcome yesterday shows the intensity of preparations that are going on. At the same time, of course, there is a big difficulty there with respect to the Greek situation because it's looking as if the July the 21st agreement just isn't sufficient, and that's been increasingly recognised in Greece and in the rest of Europe. So that situation does have to be resolved. So I think markets can, of course, move away from the utterly bleak situation that they were viewing in recent weeks. This is explaining some of the recent rally here. It's a classic kind of squeeze coming through on the markets. But at the same time, in terms of the actual resolution of this, as you say, we don't know the exact details yet. We just know that probably something is due by early November.
And Julian, I guess I don't really want to play devil's advocate, but we don't exactly know, how they were going to fund all of this. And Merkel said time and time again yesterday that there needs to be a treaty change. Now, if we start talking about treaty changes in Europe, this is going to take at least 6 months, if not 2 years. And this is how it's going to be funded.
Well, that's right. I mean, treaty changes, as you say, are very complicated things, and they do require unanimity of all the EU states involved. I mean, on one hand, of course, it's going to be useful if we do see some moves that would include greater fiscal discipline within the Eurozone as you start to move towards more of a fiscal union. For example, if the treaty change is going to be through having some kind of fiscal czar that can veto national budgets, that actually could be quite a welcome development. I think on the funding issue for the bank recapitalization, it's such early days yet, but there are funds available. Obviously, the EFSF could in theory be used entirely to recapitalize banks. That I think isn't such a good idea in itself because it doesn't then have any margin to act in secondary markets, and in particular for bond buybacks. But at the same time, there are national facilities available in many of the countries that can be mobilized, I do believe, and of course acquiring financing from sovereign wealth funds, preference share injections. I think you can actually raise the requisite funding here.
Julian, on Friday, Spain and Italy got downgraded. In 20 seconds, are we going to see more of that? Is this going to be a concern going forward, despite the fact that we get a bigger message from the leaders?
I'm sorry to say that the rating agencies are in downgrade mode here, and I don't think that they're going to be stopping that until we do see a real turning point in the fortunes of the economy in the Eurozone. And unfortunately, the economy is looking weaker. Even the latest German numbers, we think, is suggesting increasing sign that Germany will be contracting in Q4 of this year.
Are you concerned, though, that with the recap of certain banks and Dexia, Belgium's credit rating will be under pressure, but also France's might?
Well, certainly, I really wouldn't want to exclude either of those possibilities. As we were discussing earlier, Francine, you are in an environment where we are seeing persistent downgrades really coming through. And the problem, as well as I see it, is that the economic outlook has been deteriorating, especially in the Eurozone, which puts a lot of additional burden on governments in terms of revenue losses and higher expenditure. And so they really are in a squeeze. And the question is whether they can really demonstrate to these rating agencies that their fiscal plans are credible. But we can see the general tendency emerging here. And what it means from the Eurozone perspective is that even though the economic outlook is becoming quite grim here, as I mentioned earlier, I think Germany could even see a risk now of a contraction in the fourth quarter of this year, and that's for Germany, that ought to be the strongest of the large countries here. While you're in this situation, even despite that, you do need to see ongoing emphasis on fiscal austerity, because unfortunately if governments don't go down that route, then they are going to be probably facing higher yields and a greater risk of downgrades to their ratings, which then puts them in a potentially negative spiral.
But Julian, so talk me exactly what you think should happen in the next 3 weeks. So you have the French and the Germans, you know, talking about recap and kind of giving us more details, we hope, before the G20 in Cannes. Do we need also to rethink all the stress tests in Europe, especially on the French banks, which seem to be the ones that are the most problematic, taking into account a Greek default, but also a possible significant slowdown in France and Spain?
Well, that's right. I mean, as you're saying, there are a number of pieces that are beginning to fall into place, I would say here. And one of those is really what is the right value you put on the Greek debt. And the French banks were putting in a 21% haircut under the PSI debt, whereas banks from other countries were sometimes putting in significantly larger haircuts. And right now, it does seem that we're in a situation where larger haircuts may well be required, given the kind of noises that are coming out of Europe right now. So therefore, we need to see some a confirmation, really, of exactly what the private sector involvement is going to be for the Greek debt. We need a lot more clarity on that, and then you can do the stress tests in a more thorough way. Unfortunately, they do need to be revisited here, and then you can determine just what the additional capital needs are. But it's clear that we're in a situation now where banks really have to be somewhat on the overcapitalized side if we're to allay some of the concerns in some areas, and therefore impose what's called a kind of circuit breaker on the situation to separate banks from sovereigns.